Hey everyone, welcome back to Corporate Decoder. Today, DLX just filed an 8K announcing a big refinancing and acquisition completion. And I am seeing a pivotal moment for the company. Quick note, this is not financial advice, just my take on public filings for educational purposes. Deluxe Corporation just refinanced a massive chunk of its debt and closed a significant acquisition, which could reshape its future trajectory. Deluxe Corporation, a company that has been around for a while, has just announced two major moves. First, they've entered into a new credit agreement to refinance their debt. Think of this as giving their old loans a fresh makeover with new terms and potentially better interest rates. Second, and this is a big one, they've officially completed the acquisition of Celero Commerce. This acquisition is expected to significantly boost their processing capabilities. Let's break down this refinancing. Deluxe has secured a new credit facility that includes a senior secured first lien revolving credit facility worth $400 million. This is like a flexible line of credit they can draw from, repay and redraw until July 2031. They also have a senior secured first lien term loan facility for $800 million. This is a lump sum loan that will be paid back over time in installments. Now, about the interest rates, they have options. They can choose a rate based on the prime rate or a rate tied to SOFR, which is a benchmark interest rate. The exact rate will depend on which option they pick and a margin that changes based on their leverage ratio. Initially, the margins are set, but they'll adjust after the first quarter's financial statements are out. This gives Deluxe some flexibility, but also means their interest costs can go up or down depending on their financial performance and market conditions. The term loan has a pretty standard repayment schedule, with most of it due by mid-2031. Importantly, voluntary prepayments on the term loan can be made without any penalty, which is a good sign for them. This new debt is secured by pretty much all of Deluxe's assets. This means if they can't pay it back, the lenders have a strong claim on their property. It's a common practice for large loans, but it does put a lot of their assets on the line. The agreement also includes various covenants, which are essentially rules Deluxe has to follow. These cover things like how much debt they can take on, what they can invest in, and how they can use their cash, including paying dividends. So, why all this refinancing and borrowing the money from this new debt was used to pay for the acquisition of Celero Commerce? This acquisition is a big part of their strategy going forward. The revolving credit facility will also be there to help with their day-to-day operations, future acquisitions, and capital spending. Now for the Celero acquisition, Deluxe has bought Celero Commerce. This wasn't a small deal. The purchase price was around $625 million, plus some transaction expenses. This was funded by the debt we just talked about. The news headlines suggest that the combined Deluxe Celero platform is expected to process over $70 billion annually. That is a massive amount of transactions, indicating a significant boost to their payment processing business. Let's look at the price tag for Celero, around $625 million, and this was paid for using the new loans. This acquisition is a key part of Deluxe's strategy to expand its capabilities, especially in the payment processing space. We don't have the detailed financials for Celero or the combined pro forma statements yet. Those will come later in an amendment. This is pretty standard for acquisition filings. We'll have to wait to see the full financial picture of the combined entity. The creation of this new debt is essentially a direct financial obligation for Deluxe Corporation. It's on their balance sheet now, and they have to manage it. Deluxe also issued a press release announcing the closing of this deal. This is to make sure all investors have the same information at the same time, which is what Regulation FD is all about. Looking at the exhibits, we see the credit agreement itself, Exhibit 10.1, and the press release as Exhibit 99.1. These are the primary documents detailing these significant events. So, what does this all mean for Deluxe Corporation? They've taken on a substantial amount of debt to acquire a business that is expected to significantly increase their transaction processing volume. This is a bold move. They are betting heavily on the success of the Celero acquisition and the integration of its technology. The refinancing of their debt also suggests they are looking to optimize their capital structure. On the positive side, acquiring Celero could lead to significant growth and revenue synergies, as hinted by the $70 billion processing volume projection. This expansion into payment processing is a strategic move to diversify and strengthen their business. The flexible credit facility also provides them with financial agility for future needs. However, the increased debt load is a key risk. The covenants in the new credit agreement will restrict their operational and financial flexibility. The success of this acquisition hinges on their ability to effectively integrate Celero and realize the projected benefits without operational hiccups or unforeseen costs. If the integration doesn't go smoothly or if market conditions change unfavorably, managing this new debt could become challenging. The risk I am watching is how well Deluxe can integrate Celero and leverage its platform to drive profitable growth. What I'm actually looking for is whether the projected $70 billion annual processing volume translates into meaningful improvements in their top and bottom lines. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Check out the Discord in the description.